So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again at optionalpha.com, and welcome back to The Daily Call. Today we are going to answer an email that I got from a user, which is basically what are the advantages of trading Strangles versus Iron Condor. So the email from one of our members said, my Thinkorswim platform doesn't allow me to write Straddles and Strangles because of the unlimited loss risk. They get a message that says it's illegal to write these shares. They have an illegal -1 shares. However, I can do an Iron Condor because the risk is limited. So when I see the Iron Condor diagram, it is the same as a Strangle, except for the defined risk. So again, they basically are asking, what are the advantages of using a Straddle or a Strangle over an Iron Condor? So the clear advantage of using Straddles and Strangles versus Iron Condors is a couple different things. So I think it's not just one thing. There's a couple clear advantages to using them. The first is that in most cases, you end up generating more total dollar profits. When we go back and backtest lots and lots of strategies, we're talking hundreds of thousands of strategies, Strangles and Straddles end up generating more dollar profits overall. So when you look at a $100,000 account, which account grew by the most total dollars, had the biggest total return? It's probably the accounts that have Straddles and Strangles. Now that said, the downside to that basic advantage is that you probably have more fluctuations in your account. So we saw more gyrations, maybe a little bit more volatility in the E&L curve, so bigger rises and falls. But if you're willing to hold through that, you generally get higher expected returns. Now, the other advantage to trading Strangles versus Iron Condors is that they generally hit their profit targets much faster, which also means that you're holding the trades for a much shorter time period. So when you're trading just pure naked options or option selling, you'll see that those options tend to decay very quickly in value and they hit their profit targets much faster, which means you don't have to hold them as long. Now compare this to trading Iron Condors. With an Iron Condor, you are able to control risk a little bit better, so you don't have the gyrations in your P&L profit statement as much as you do with a Straddle or Strangle. But with Iron Condors, since you are buying options and using spreads on either side of your short strikes, you generally see those trades decay at a much slower pace. So you don't hit your profit targets as quickly. Not to say you don't hit them at all, because you probably will, but it just might take more time. It might take an extra week or an extra 2 weeks, which generally means you're holding trades a little bit longer than we would ideally like to do. So I think those are really kind of the clear distinctions between those two strategies. In either case, I think generally they're, one's good for one particular type of trader, one's good for another type of trader. So I wouldn't throw my hands up and say I would only do one versus the other. I think there's a lot of factors that have to go into it. We use Iron Condors and Iron Butterflies a lot here at Option Alpha, mainly because during low implied volatility markets, those out of the money options that we can buy to create defined risk are really cheap. So if we're selling a Straddle and we can collect $300 of premium and then convert that into an Iron Butterfly and basically give up $500 or $5 of the $300. So if it only costs us $5 to buy those far outside wings, but we create defined risk, we give ourselves protection, then it's worth it, right? We're still collecting $295 of premium. What's another $5 that we can pay for risk protection and management on the further ends of the extreme? So hopefully this helps out. As always, if you guys have any questions like the one that we just went over today, please let me know. We're always looking for new content here for the Daily Call and for our website. So the more the merrier. I love getting questions. We just basically add these to the list here, and we'll just continue to create this huge working list of questions that you guys have around options trading. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.